Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark comments on what appears to be a correction in both precious metals and the junior miners. Inside Track President Eric Hadik on whether there might be an uncanny connection between earthquakes and the markets. This past week also marked the anniversary of last year's Black Friday. Are we in for a repeat? And what role does the U.S. presidential cycle play on the markets, especially for gold and silver? We talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're chatting with Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Thank you, Jim.
Precious metals have been very precious and very profitable over the last 6 months. Are they going to continue to be?
I believe they will, but not in the immediate future. I take a look at an 8 to 8.5 year cycle in the precious metals, and the bottom that we had in gold last year came prematurely from that cycle perspective. Ideally, we would be looking for the end of the third quarter this year through the first quarter of next year as an optimum low for gold. So if it were to correct here, which I think it's in the process of doing at this point, and were to hold above the levels that we saw at the 1050 back in December, if it were to do that in the next couple of months, that would set up very, very nicely for a longer-term move to the upside, because my view here is that this first leg that we've had into July, August is just that. It's a first leg of a bull market. We should be getting a good, hard, deep correction, and then you can have another 2 to 3 years on the upside. But it's the best thing that we can do at this point is to have a nice, significant break, and especially over in the miners, and we've seen just that. Silver market took a hit this week, and we had the golds. You take a look at the XAU, the Huey, the GDX, all of the indices of the gold miners down 10% or more on the week. Worst week we've had this year, and it clearly fits in line with what we've been looking for. You typically, in the first leg of a bull, are going to have a 26 to 30 week rally. This one peaked out at the 29th week, and we've now had 2 down weeks. So looking forward, and I've got a piece of research that we can send out to people if they send in a request. Looking forward, you would expect here that you would have a break in these miners of anywhere between 5 and 11 weeks, the optimum being about 7, so that'll push us into the latter part of September, and the corrections can be pretty darn deep. When I take a look at these broad indices, and we can go back with the Barron's Gold Mining Index all the way back into the 1940s, the style of move that we've had in this correction, typically the first 2 months are hard down. You have a very good chance of testing the long-term averages. A 20-month average is what I'm looking at. If we were to hit that in this first 2 months of the break, so that would be in through September, that could be the important low from which we could have the next rally. If we just have a sell-off that holds well above that moving average, you're probably going to see a more complex type of corrective phase. So you get an initial move here into September, early October, get a bounce, and again get a lower low as we move towards the tail end of the year. That would then likewise be setting up for another really good move in 2017.
Ross, is it a good idea for people to keep their hands on their gold certificates right now?
Well, I think so, because I believe that this can be a really good long-term bull market move. And what you would expect here is that you're going to be given that second good opportunity, if you haven't already stepped up to the plate here in the first part of or the latter part of this last year or the early part of this year. This is where your next really good opportunity comes from. And I always like to think of bullion as an insurance policy against government, against currency moves. And clearly, like even, if you look at Canadians in the last few years, for all the gold price quoted in U.S. dollars went down for 5 years, for Canadians it only went down for the first 2 years, and then it stabilized very nicely. So it was doing what it should be doing. It was protecting the value of your assets. And if we were to say a break in other commodities like the oil market, which then probably takes Canadian dollar down with it, gold would be a great hedge to have in place. So if you've got a bullion position, just keep that core position. Don't worry about it on a day-to-day basis. And sometime here in this next 2 calendar quarters, I would think you get a chance to put on an additional holding there.
Ross, thank you. Oh, boy. Ross, an interesting point. Russia and China have been stockpiling gold along with India. Meanwhile, countries like Canada have gotten rid of all their gold stocks. Who's on the right track here?
Well, the Canadian government has been reducing its position for the better part of 2 decades, and it was only at the tail end of last year that they finally gave up the last of it. It reminds me of what the British did when they sold off their gold just into the bottom that we had back in 2001. So I think that the Russians and the Chinese are making a far better decision here in terms of their long-term bullion holdings. There's no doubt in my mind on that one.
Ross, thank you so much for being on This Week in Money.
Always pleasure, Jim, and just to let people know once again, I do have a report on the gold miners if they would like to email me at ross.clark@cibc.ca.
Thanks again, Ross. Coming up, Eric Hadik, the president of Inside Track, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik. He's the president of InsideTrack.com. Welcome back to This Week in Money, Eric.
Thanks for having me back, Jim. It's my pleasure.
Can you maybe tell us a little bit about Inside Track before we get going into the real meat of the show?
Sure. We are a advisory service analyzing the markets, primarily futures markets, but also into the equity indices and Forex, precious metals. But one of the primary things that I bring to that analysis, kind of the backdrop or the foundation, is a extensive study of cycles and how they impact the markets, how they impact our world, everything from nature to stock trading. And so that's just a little snippet of what we provide at Inside Track.
And Inside Track is based in Chicago?
Just outside of Chicago, yes.
Far enough away to say it's home, but far enough away to say that you don't have the problems.
Exactly,
Eric, this is the anniversary of Black Friday last August. Does it look like we're falling into the same pattern again?
No, not in the immediate outlook, but there is certainly a strong cyclic linkage to that overall decline. But what it's telling me is to look for a sharper move down in about a month, and then a secondary one a month or two after that. And just to quickly explain, one of the factors leading into that is there has been a very consistent 32 to 33 week cycle in the stock indices, and an overarching 66 week cycle, which is 15 to 16 months, that has governed the indices since at least 2009. And both of those cycles, of course, every second phase of the 32 to 33 week converges with each individual phase of the 66 week. And just to give a little example, that cycle came into play in early September of 2014, 2 years ago, and was auguring a quick, sharp correction, which we saw into mid-October of 2014. But then the ensuing phases were when I was expecting more significant tops and more significant sell-offs within usually the 1 to 2 months that follow that cycle. So the next phase of it was in late April, early May of 2015, which is exactly when most of the indices topped. That was also the last phase of this 66-week cycle. So when you have the two of them going together, you often have a two-phase drop following it. So you get an initial decline, then a rebound, and then a sharper drop, which is what we saw leading into late August of last year, 2015. You go to the next phase of the 32 to 33 week cycle. That came into play in mid-December, and throughout the whole fourth quarter of last year, I kept warning readers and listeners to wait until after mid-December for the sharpest decline to take hold. And that was exactly when it kicked in, and we saw that sharp sell-off into late January, early February of 2016. And once we saw that, I started turning focus to mid-August of 2016, which is the next phase of both the 32 to 33 week cycle and the 66 week cycle. So all that to say is during this next phase, I'm expecting something that looks a little bit like the May through August period of 2015, although there are other factors that skew that a bit and have me looking for more specific distinction from that as well. But something where we'll see an initial decline, probably into late September or so, a bounce, and then a bigger drop in November of this year. So there is certainly a correlation or a link to the Black Friday of 2015, but not looking for the same thing to happen on the anniversary of it.
Do people tend to look for anniversaries when they're looking at cycles?
That is certainly one of the more significant and more well-known cycles. It's a very simple 360-degree cycle. You know, you've gone through 1 year, which does have a natural and a geologic aspect to it, and there are things that will happen on anniversary dates, but I think where the markets are concerned, you usually have to have enough time elapse before enough people will forget about an anniversary, and then the markets kind of have a little more freedom to do similar things when it's going to surprise the majority of people. I often hear, like you're talking about, 1 or 2 years later, everyone touting the anniversary of this or that, and the markets just don't operate like that. And occasionally you'll see something significant, but there's also a strong distinction. And So it is, yes, certainly something to watch, but usually you don't see a repeat.
Again, humans like to have reasons for things. A natural cycle is always blamed, it seems to me, on, we had an earthquake last night. It must be connected. Is there a connection between natural events and what happens in the markets?
Oh, I absolutely believe that and contend that, and that is one of the things that I continue to hammer away at particularly in my monthly publication, where I deal more with broader cycles and what impact I expect them to have for the coming months and years, sometimes even beyond that. But I definitely believe that the natural cycles are closely correlated with market cycles, but there's enough distinction, sometimes a lag, that very few people really see the correlation. And also, a lot of these natural cycles you talk about are broader in time frames and in terms. When you mention even things like earthquakes, I've discussed a recurring 40-year cycle of earthquake swarms when you see a large grouping of major earthquakes all within a pretty narrow window of time, and also volcanoes. And really one of the conclusions that I made several years ago was that I thought the second half of this decade would see a steadily increasing occurrence of both first earthquakes and then even seeing some major volcanoes leading into the end of this decade. But one of the areas that I was looking at for this year, for 2016, was for an increase of earthquakes on what is known as the Alpide Belt. And whereas a lot of people are familiar with the Ring of Fire that goes around the whole Pacific from, South America and our west coast up and around to Japan and down the eastern coast of Asia, the Alpide Belt is the second most active belt, and it runs from the western side of Indonesia and northern part up and through Central Asia and across the Middle East. It hits a lot of your places like Afghanistan, Pakistan, Iran, Turkey, and then out through the Mediterranean. And so several of the publications I did in early 2016 and even late 2015 were talking about looking for another spike in Alpide Belt quakes in the coming couple of years. And this recent one is in central Italy, which is right on that Alpide Belt. And it would not surprise me at all to see more quakes along that. It can be hundreds or even thousands of miles away, but you tend to see these sequence, and it wouldn't be surprising to see ones in Indonesia or in that Afghanistan area, the surrounding countries as well. So it is a natural phenomenon, and when you get into those swarm periods, also tends to be when the market gets more unsettled. You tend to see even there are often geopolitical and military types of things that become more prevalent during those periods. But as I say, it's often a 3 to 5 year period, and so to identify the link, or for those that want an exact day or week to pinpoint something, these are not the type of cycles that work for that. There are more specific cycles you can monitor in the markets, daily and weekly cycles, but to try and correlate the natural ones that are on a bigger calendar to very specific, minute things in the markets, is going to lead to a lot of frustration. So I think it's important to distinguish what you're looking at. And more than anything, I'm kind of laying the foundation or the backdrop for why I think 2016 through 2019 is going to be a increasingly unsettled period in the world, naturally and geophysically, in the world geopolitically and perhaps even militarily, and in the markets. And you'll see that in things from stock indices and paper assets beginning to struggle, and also in things like precious metals to come back into favor even more.
You're listening to This Week in Money. I'm Jim Goddard. Our guest is Eric Hadik, president of InsideTrack.com. Eric, with these natural cycles bouncing in, has it thrown off the cycles with the stock market because we've had so many interferences with it, official ones, so-called quantitative easing? If Japan's not doing it, China is, Europe is, the U.S. is. Has that thrown off the natural cycle of things?
I don't think so, and I think that there are times where it might push a uptrend a little bit farther than the ideal or optimum scenario would suggest. And they often talk about in an uptrend, tops shift to the right, meaning that they do the actual price, the final intraday or intraweek spike high might occur a little bit after when the majority of cycles converged. But I've heard those kind of questions for decades. Going back to precious metals, when in the early 2000s, when I was talking about cycles making a big shift, and you could see a 5 to 10 year surge in gold and silver, and all I kept hearing was, well, but there's central bank selling, there's consistent central bank selling, there has been for years, they're not going to let up. And gold and silver forged their way ahead, and ultimately the central banks started to pull off of the selling. But it was the market cycles that turned first, headed up first, and kind of pushed their way through before the fundamental things then shifted. Similar occurrence in the early 2000s, where you were hearing the same thing. I should say mid-2000s, really. We've got all this easing, these low interest rates, the housing market going great, and all the while I was talking about this just recurring 17 and 34-year cycle that was predicting a late 2007 peak and a 1 to 3 year drop of 35 to 50%. I wrote those two cycle and price projections for a year and a half leading into late 2007, and all I kept hearing was, well, it just can't happen because you've got all these great things that are going to, and you've got the plunge protection team, and you've got all this. When the cycles and when the markets are ready, they will exert their will, and then it's the fundamentals that you see suddenly shift or get delayed, or something changes their timing. So I think that I've talked about where I thought 2015 and 2016, all the way until late 2016, would be a very lengthy topping process, a bit like you saw in the Dow Industrials, and you have to focus on the industrials themselves, between 2000 and mid to late 2001. And I thought we'd see a similar pattern from early 2015 to late 2016, which is pretty much what we have seen. And so the market is trying to top, and yes, you have things like the easing, although, every few weeks, the Fed wants to talk about the possibility of rates going up soon. But this topping process, often when you have the washout, it occurs in a very quick period of time, and it's because it catches so many people by surprise. And when that's happening, when that panic sets in, all those fundamentals mean nothing because you've got emotional fear and or greed and panic taking hold. And that's really what technical and psychoanalysis measures is mass human psychology and emotional swings, which is really what the markets are.
Last year's major drop in the markets was blamed on the trading robots. Was that overemphasized?
I think so. I think that is certainly going to create your overthrow, meaning, going beyond what a particular low or in some cases a high should be. So yes, at the tail end of a sell-off, sometimes you do have those type of anomalies that project it farther than it really should. But that's been the case for centuries, that a mania or, an uptrend will have factors that push it way beyond where it should go to the upside, and panic, fear, and then some sort of maybe financial debacle will extend things to the downside more than they should. And I'm putting air quotes around that should go to the downside. So, now it's your robot trading, your program trading, your computerized stuff, and 5 years from now it'll be something different. But you certainly get that. You get that at the end of a parabola, both to the upside or downside, and so it's just what it's going to be this time.
Has it been a waste of money for central banks to start snapping up shares and so on to try to boost markets? Because in the end, the market's going to go down at some point.
Well, I guess it depends on your perspective and who you're asking whether it's a waste or not. If it has allowed a longer period of time to try and solve some problems, which I think is their rationalization each time, if they actually do find some solutions, then you could argue that it was a necessary evil. But the point you're making, which, any of your free market advocates will, is that inevitably the market's going to go where it wants, but it's all the unintended consequences and the residual effects that nobody's quite sure what to anticipate and which of the two scenarios is worse. And, in the end, I do believe that the market will have its way, and it may be triggered by some sort of external event. It may be some sort of military shock or surprise. It may be some sort of Earth-related event when you talk about major quakes and volcanoes, if they ever hit a critical area. And it's not that would change the whole global financial system, but it would send enough of a panic that you'd get an emotional reaction to it in the markets. And there's a lot of things that can come out of left field and finally allow the market to go where it has been seeking to go all along.
The banks, of course, were bailed out in the last collapse. Should the banks be allowed to fail if they find themselves in that situation again?
From a free market perspective, you would argue that yes, you should allow, the natural course of things to run their course. But there's also a pragmatic and a realistic aspect to that too. And, who would get hurt the worst, what it would trigger. I think a lot of your gold bugs and whatnot, almost, when they talk about things like that, they're salivating, and it's almost like they kind of wish for that. Well, that old adage, be careful what you wish for, you might just get it. A true collapse could set things back decades if you really allowed something like that to run its course. And part of that problem is because they've been artificially supported and there hasn't been the proper accountability that there should have been for decades or centuries, but you are where you are now. You have to deal with the reality at present. And so to argue just the very sterile theoretical aspect of, yes, they should be allowed to fail, well, what can you tell me all of the ramifications of that and the domino effect, 10 dominoes down the line, and, does that put a particular country in a very vulnerable position where you get turmoil and upheaval in your metropolitan areas, and all the focus is turned to domestic things, and now all of a sudden you're vulnerable from a global geopolitical foreign enemy perspective. There's so many things that factor into that. That's why I'm glad I'm not a politician, and because you're kind of damned if you do, damned if you don't. And if you're handed this this deck of cards that you've got, and it's not a really pretty scenario, you're going to have benefits and detriments to both ways of dealing with it. I certainly think that there should have been and still should be far more accountability and much stronger consequences to those that are revealed to be culpable in some of those things, some of the decisions made, and some of the where money is proportioned or apportioned. But to just take a blanket, let them fail. If you can tell me all the ramifications of that, then I could make that decision a little easier.
Well, Britain does have legislation that allows them to jail bank CEOs if they allow their bank to fail. Why can't Canada and the U.S. have the same legislation?
Ask those few hundred in Congress and the Senate. And number one, there's probably not the political will to do it, and to see it through. And by the time that political will is there, it would probably be after another catastrophic crash. And at that point, the barn door's open, the horses are out, and what's really the point? That's kind of corroborating what I was saying, that I certainly believe that there should be a lot more accountability, but you have to make decisions based on the reality that we're in, and you and I don't have the power to enact any of that, so it does just become kind of a debate to hear ourselves talk.
And of course, we know the banks are major contributors to political parties, so probably nothing bad would happen to them.
Yeah, and you start looking at the banks on one side, and there are just as powerful of entities spread around the political spectrum, not just banks, that have their own similar vulnerabilities and problems. Maybe the majority of them aren't as far-reaching as the banks, but if you want to start debating that, you have to go all the way back to the merits or lack of merits to fractional reserve banking, and then you can debate go back to the Federal Reserve Act of 1913, I believe. And you just, again, there's so many factors that are already just pretty much carved in stone. You're not going to change them. So now what do you do with what you have, with the cards that you've been dealt? you could sit there and say there are 4 aces in that deck that I don't have, and I really deserve to get one of them. But if none of them were dealt, you got to play the hands you are dealt.
How big a role does the U.S. presidential cycle play with the business cycles?
I think that there is a decent correlation, and you can look at that even just with the swings in the economy and, who's in power. You go back to 2008. Well, that was pretty much a given when things started collapsing, that it was very unlikely that a Republican was going to get elected to office in 2008 with everything that was fleshing out at that time. And, I was just watching some old documentaries on the 80s and at the end of the 70s, and kind of a similar thing that, you can debate the strengths and weaknesses of President Carter in the late 70s, but when you look at the perfect storm of both inflation and a lot of that was a result of issues with the dollar and with Bretton Woods and with the Jamaica Agreement in the early and mid 70s, and gold, the shutting of the gold window. And then you had some food crises, then you had double oil shocks in 73 and 79. All these things created such a mess leading into the 1980 election that it would have been very hard for a Democrat to get elected then too. So there's certainly economic swings and financial cycles that you can't ignore. Now, this coming election in the U.S. is a very intriguing one, and in fact, there's one aspect and one possibility that I have heard nobody talk or write about, and I'm going to be featuring it in my September Inside Track, so I'm not going to discuss it here, but there's certainly a cycle argument for this unique scenario becoming a possibility, and just with what you have in the economic cycles, I think it's more going to be an issue of who is in office, and if the things I expect in 2017 and 2018 really do play out, that's going to be a much bigger challenge for whoever is in office at that time than even things leading into the election.
Are gold and silver also connected to the presidential cycle?
To some extent, yes, but there is lag and lead time there. I would say probably it's a more subtle, less definitive connection, and that there's other things at work there which will ultimately impact the electorate and the psychology of the electorate, and have its impact on the election cycle. But I think that the thing I've been talking about is I thought 2016 would be the golden year. That's what I termed it, but I also was very careful to clarify what I meant by that, and I thought that we would see the first 3 to 6 month advance in gold and silver in 2016, that would be the year that did mark the turning point, but that the real accelerated and more dynamic advance would wait until 2017, 2018. And that is another example of a textbook correlation between not only cycles, but Elliott wave, for those that are familiar with that approach to the markets. And you have your initial advance, which I was just talking about in gold and silver. Then you have a pullback, which I was projecting for the third quarter of 2016. We seem to be having that take hold. But then you get the second advance which is called the third wave. Your first wave is up, second wave is down, third wave is up. That's the one that's typically the most dynamic, the most accelerated, is the true trend, and that's when you normally see your fundamental events coincide with it. So even during the initial run-up in gold and silver, which is the one wave, often the fundamentals aren't strongly corroborating that, and that's when you get a lot of argument from the talking heads of, well, this can't be, it's not sustainable, this is just a short covering. Then you see some more consolidation, and then all of a sudden you'll see, entering into 2017, gold and silver start to mount a more sustained rally, something that is technically more solid, and it will probably be the triggering of some corresponding fundamental event, maybe mid-2017, maybe late 2017, when gold and silver really take off, and those that want to be able to pin it to one thing will say, oh, well, this happened and nobody could have seen that coming. But really the markets were warning of it for 6 months, 12 months, sometimes a year or two beforehand. If you're watching and seeing what is developing, and then it's that accelerated move where you get the fundamental event that most people can feel comfortable saying, oh, that's what caused it.
What kind of cycle do you see for crude oil?
I have been, really, the outlook hasn't changed since about mid-2014, and that was that I thought we'd see a very strong drop into the very beginning of 2016, and then it would take a year or more for a bottoming process to really work its way out, that you'd see some decent rallies and then some almost as proportionally powerful sell-offs, but it would be a volatile bottoming process throughout 2016. And in fact, January of 2017 is another key time frame that I've been talking about. And I think after that is when crude and your other energy and oil products will begin to mount a more sustained advance themselves. But until then, I think that that crude is locked in a $20 or $30 trading range down at the lower end of its last 10-year trading range.
Some analysts have said that oil could hit $65 again. Do you see that price in the near future?
Near future, I don't at this point. Certainly, there are some things technically that could change and make me reassess that. And I guess we'd have to define what near term is, but in the coming weeks and next couple of months, I don't see it as a strong probability, but it is the upper extreme of where resistance comes into play, so I wouldn't completely discount that possibility.
The Canadian dollar seems to be tied at the hip to oil. Should it be?
Well, that's I don't know whether it should or shouldn't, but again, it is reality. It's the cards that are dealt, and so that was back in 2014 and 2015. I kind of coined this term that I was talking about, and I called it the crucible, but I spelled that with hyphens, CRU for crude, -CA for the Canadian dollar, -BLE for the ruble, and talking about how all three of them were very negative into early 2016, and they actually had a lot of very distinct cycles and technicals among themselves, that it was different duration of cycles, for one as opposed to the other, but they were all converging in early 2016 for when I thought we would see the culmination of a decline, and that then in all of them you'd have a bottoming process throughout 2016. And, as far as the correlation, you'll have to talk to your own politicians and economic leaders and oil producers as to how closely that correlation's going to remain. But for now, it certainly is a very strong correlation. When you're looking at monthly and yearly cycles, they do really trade in close lockstep with each other. But it's when you have, when crude oil is kind of settled into a range, well then something like the Canadian dollar is able to move and swing on other factors. But when crude is making a big move, it's going to carry those petro-related currencies along with it. And that's a perfect textbook example of what I call my axiom of market correlation. And it's this idea that a lot of people want to correlate one market to another day to day, week to week, and that's often not the case. But when the lead market, whichever one is the driving force, when that's in a parabolic phase, that's when the correlation is strongest. But you also have to be careful. As soon as that parabolic phase is complete, the following, the lagging markets will very steadily go back to focusing on their own governing fundamentals and factors. So you get, when you look at the big trends, yes, they're working in such close correlation to each other. But then when you break it down to your day-to-day, week-to-week, there's a lot of independence and almost a 180-degree non-correlation at times.
Taking a look at the bond market, is it going to recover?
I still contend that we are at the very tail end of a major multi-decade bull market in bonds, bear market in interest rates, and that 2016 is the culmination of that. It wouldn't surprise me. I'm looking at the 30-year bond futures and the 10-year note futures so that when someone hears my outlook, they at least have the context of that. I'm looking for the possibility of one final spike high in those markets in either December of 2016 or January of 2017. And that might only be a quick retest of recent highs. Maybe on some flight to quality type of scare or something like that. But once they're through that period, I envision a multi-year downtrend beginning to take hold, and that could also be correlated to my outlook for more inflationary moves in commodities and precious metals in 2017, 2018. But I think that bonds are in a major topping process, and when that topping process is complete, you better start watching out below.
The U.S. dollar has been the choice currency for the past several years. Will it continue to do so?
I think that it has another wave up, as I have explained. When you look at all the fiat currencies, the paper, the debt-backed currencies, it's, in many respects, it's kind of a race to the bottom. And you saw the dollar being the one during the 2000s that was heading down the sharpest. And my expectation from 2011 on was that the euro would be the one leading that way down. So the dollar, is the healthiest horse in the glue factory right now. But that doesn't mean that it's out of the woods. on a 3 to 5 year basis, and just from its own underlying integrity, I think there's some real challenges ahead. But looking at just a Forex cross-currency pricing scenario or correlation, I think the dollar index has another wave up before it is going to top out, and that could be more a function of the euro having another washout to the downside, which, then benefits every other. You have the yen will rally against it, you'll have gold rallying against it, and the dollar, which so many traders will write to me pretty indignant and say there's no way the dollar and gold could rally at the same time. Gold's priced in dollars, the quotes that you're talking about, and they just, that's the correlation, just doesn't happen. And yet it has happened multiple times. It's not indefinite, doesn't keep going for months and years, but there are those key time frames, and they're the most significant moves often, where you see that. And so I do think that you've got another drop in the euro coming, and I think that the dollar will probably be able to ride that to new multi-year highs. But when you look at it on a 50-year chart, 100-year chart, the whole rally from 2008, 2009 until now is just a drop in the bucket or a dead cat bounce, and that there still is a lot of underlying trouble there.
Eric, how can people find out more about Inside Track?
The best way would be to visit our website at InsideTrack.com, spelled with the extra I in the middle, so that's INSIIDETRACK.com. And also our secondary website, 40-Year Cycle, the number 40, and then the words yearcycle.com, because that's really one of the primary cycles that I've been writing about the last decade, and so we spawned a second website from that several years ago to compile a lot of that 40-year cycle analysis. So they can view a lot of the samples there and get an idea for what we offer, and even contact us through the website to get some free trial or some sample publications. They're the two best ways to contact us.
Eric, thank you so much for chatting with This Week in Money.
Thanks for having me back, Jim. It's a pleasure.
My guest has been Eric Hadik, president of InsideTrack.com. That wraps up our show for this week. We'd like to thank our guests, Ross Clark and Eric Hadik, and thank you for listening. Questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.